Welcome to our channel, Finance Experts. Let's start our discussion on a very popular topic nowadays, the future of sustainable investing, how to align your investments with your values. Sustainable investing is a method of investing that incorporates governance, social, and environmental considerations into investment choices. As more investors want to match their assets with their values, this style of investing has grown in popularity recently. With the increased awareness of climate change and the demand for more ethical corporate practices, the future of sustainable investing appears bright. Investors can have a good impact as well as possibly experience long-term financial gains by funding businesses that place a high priority on sustainability and social responsibility. Sustainable investing. What is it? By converting investor funds into investment opportunities with risks that correspond to anticipated rewards, traditional investing creates value. To improve long-term results, sustainable investing integrates conventional investing with environmental, social, and governance-related knowledge. The evolution of investing can in many respects be understood as including sustainable investing. Participants in the sector are beginning to realize that some ESG factors have an economic impact, particularly over the long term, and that it is crucial to take these variables into account. The phrase sustainable investing describes a number of methods that investors employ to increase their financial returns while promoting long-term environmental or social benefits. Avoiding businesses or industries whose goods are at odds with your goals, morals, or beliefs can be a straightforward solution. Additionally, you can make investments that you think will help you achieve your moral, political, or environmental objectives. If conserving underwater creatures is your passion, there is undoubtedly an investment vehicle that will meet your objectives. It is worthwhile to delve into two common categories of sustainable investing strategies. Negative screening is the first, and ESG, or environmental, social, and corporate governance, is the second. ESG stands for environmental. An organization's environmental impact is determined by the sustainable business practices it employs to lessen its environmental impact and avoid having a negative impact on the future resource availability, all while maintaining profitability and operational effectiveness. Examples include cutting back on waste, utilizing renewable energy and resources, adopting suggested practices, lowering carbon footprints, etc. Social. A company's social impact is how it affects its workers, clients, and neighborhoods and communities in which it operates. Social impact includes issues including consumer happiness, data usage and privacy, staff involvement and training, diversity and inclusion, charity, and community outreach. Governance. The way a corporation is run through its organizational structure and leadership is referred to as governance. This covers issues like the makeup of the board of directors, CEO compensation, operational structures and efficiencies, profit objectives and directives, how bribery and corruption are handled, and how important ESG is to the board and management of the organization. Now let's take some time to discover the two main parts of sustainable investments. Negative screening eliminates specific markets, companies, or strategies from a portfolio based on what you want to steer clear of buying. ESG, on the other hand, measures how much a firm contributes to certain social goals and is more like reweighing your portfolio to prioritize companies with higher ESG scores. The numerous index funds that employ each of these strategies frequently combine them. Three essential components of sustainable investing are: the sustainable investment adds to asset management theory and does not mean that fundamental ideas are disregarded. By incorporating ESG factors, sustainable investing creates a deeper understanding of how value will be created in the future. Diverse stakeholders are taken into account in sustainable investing in line with how businesses are evolving. Having a sustainable portfolio seems like a really good concept, and it might feel even better. But there are two things to bear in mind if you wish to invest sustainably. The first is your expected income. The second is how much the investment aligns with your priorities and values. These two criteria must be evaluated together. You could be ready to accept the trade-off if a sustainable portfolio has somewhat lower predicted returns but perfectly reflects your beliefs and values. In other words, you don't mind a smaller return as long as the business meets your expectations. You will need to consider it and make peace with it. How and why should you invest in sustainability? The demand for investment companies to adopt the sustainable investing model is increasing as interest in sustainable investing continues to soar. The alternative of preserving the way things are leaves the investment business exposed to the decline at a time when the industry is confronted by increased end client and regulatory demands as well as difficult economic conditions. The industry's leadership in innovation and investing theory and practice, as well as data management, will be crucial for the next stage of development. Future prospects are incredibly promising if these are present. Tips for financial sustainability. Create a functional model. The operational backbone for enabling implementation, as well as for identifying, communicating, and achieving sustainable investment goals, is appropriate governance. An oversight committee made up of the chief executive, chief investment officer, investment committee, risk committee, and board of directors, together with occasionally supporting professionals, is a typical governance arrangement. Key stakeholders can be brought into alignment with the use of a set of codified and recorded sustainable investing goals, including the usage of an annual sustainability report or website. Asset owners must identify the personnel, expertise, data, and tools required to support a dynamic sustainable investing strategy over the long term in addition to governance and communication. Set your investment strategy in motion. Asset owners can think about how to integrate the various implementation strategies in their assets and set a time frame for more extensively integrating sustainable investing across portfolios after understanding the various implementation strategies. When current investment mandates expire or there is additional money available to invest, institutions may decide to start by introducing sustainability considerations. In order to develop internal proof of concept, they might also take into account a specific strategy made up of one or more asset classes that reflect the entire asset allocation. For instance, a focused fixed income strategy may look into allocations for sustainable, socially responsible, and green bonds. Implementation and improvement over a long period of time, as well as a supporting operational and governance approach, may be needed to achieve entire portfolio integration across different asset classes as well as investment teams. Passive funds. Passive managers utilize a rules-based strategy that aims to generate returns comparable to the broad market, while active managers aim to exceed the market target. However, the addition of ESG information makes passive investing much more challenging. There is no market standard for sustainable indices in contrast to market cap-weighted stock indices. Instead, various index providers will have various perspectives on ESG data. Additionally, passive sustainable funds can range in appearance from one another. Some may resemble typical index funds with a preference for a certain style, market cap, or area. They could also resemble strategic beta funds, which consistently apply fundamental standards. Instead of risky concentrated funds, prioritize diverse funds. In an effort to directly match their investments with their values, investors frequently make the error of purchasing funds that are extremely concentrated in a single sector when it comes to sustainable investing. For the heart of your portfolio, diversified stock funds are preferable because they typically have market-level risk and may be able to keep you invested during up and down markets. If you're going to invest in riskier funds, I advise putting only a tiny percentage of your overall portfolio into these more speculative funds. Recent years have seen a rise in the popularity of sustainable investment as people start to give more weight to the effects of their financial choices. In actuality, sustainable assets are in accordance with a report by the Forum for Sustainable and Responsible Investment. In this video, we have discussed the prospects for sustainable investing and offer advice on how to make sure the investments you make are consistent with your moral principles and sustainable. Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comment section. Thanks for watching, and we'll see you in the next video.